Good morning, good morning. How you doing today? That there. There's some. Gonna promote this really quick, guys. Give me a sec.
Consumer confidence for October coming at 94.6. That's a point lower than September's revised 95.6 reading. This all from the Conference Board. So let's go inside the numbers, including how consumers are likely to react to the recent wave of layoff announcements. I'm joined by Yelena Shulyetyeva, the Conference Board senior U.S. economist. Good to see you. So this number inching down by a point, but it is a little bit better than economists had forecast. So just give us your big picture impression of what we learned today.
So, yes, you're right, Julie. Consumer confidence is virtually unchanged in October. We saw present situation inching higher, future expectations inching lower here. One thing that we monitor very closely in this report is the labor differential. So consumers' assessment of jobs availability.
That drop this off. I got a couple of things to talk about. Mainly, look at the 3-month chart. Here, my prediction. Look at this chart. I kind of drew. Haven't touched it for 2 weeks. Look where it kind of followed that path. So that prediction was correct. That's plus 8 for mortgage rates. Hurting a little bit today, but if you look at the last couple of weeks, up until September, we're pretty good. We're looking pretty good, all things considered. That's a look at the 5-day. So we started the month 10-9, significant drop that day, that week, at steady up and down, this range up and over 4.0, under 4.0 for the last 2. Again, highlights lower overall interest rates compared to the. I'll let you think about that, but we're going to be watching some videos. That kind of is going to help explain what's going on. I'm going to go back a few. So there's going to be probably 5 to 7 videos to watch. But again, very important you do. We'll put these. I'm going to mute myself, but just listen.
Dallas Federal Reserve's business activity index rising to -5 from -8.7. So still challenged, but not as challenged as it was in the prior month. The outlook for business activity remains positive at 7, but it did drop down from 8.4. These surveys do a decent job of following the outlook for the general numbers for the national economy. Each survey is a little different. Production was unchanged at 5.2. New orders index remains negative at minus 1.7. And the outlook for business conditions did actually worsen. A slight increase in employment, but a contraction in work hours, something to think about there. And the expectations for activity remain positive, but they fell to 21 from 31.6. Price and wage pressures eased. That's important. With the finished goods price index, this is one that hopefully correlates with the national inflation data. It dropped to 7.7, was the lowest since March of 2025, but the outlook remains elevated. As you say, Leslie and Carl, we're trying to do what we can to come up with data here. These regional Fed surveys in aggregate do a good job of following employment index, but each individual survey has its ups and downs relative to the national data.
So much interesting macro coverage today, Steve, in the papers. The Times looking at companies no longer shielding buyers from tariffs. The Journal saying renters have the upper hand and are probably going to keep it. The Journal's op-ed page taking on Trump, Reagan, saying that the Gipper was in fact a free trader.
Yeah, absolutely. I mean, there's very little doubt of where Ronald Reagan stood on the issue of tariffs. A big part of the opening up of the United States to the world and the world to the United States began under Ronald Reagan. So I think Canada has that right, if I could say that. And in terms of the broader coverage, Carl, the issue is kind of flying blind here. And all of these company anecdotes that we're following are a big part of our current understanding of what's happening. The employment front looks a little soft. The price front is something we're following carefully. And just as a little teaser, Carl, of our survey that's coming out tomorrow, our Fed survey ahead of the Fed meeting, we did ask about this issue of, were you guys wrong about tariff inflation and why? And I'll tell you right now, the why is because they think more is coming.
Palmer. Cheryl, it's always good to get your check on the market with your help. Thank you so much for joining us.
Great to see you. Thank you for having me this morning, of course.
Can you walk us through at least the closure guidance?
Yeah, I mean, we did modify our closings modestly, right? I think consensus, Carl, was right around 13,000 closings for 2025, and we brought it down to the midpoint. The midpoint of our new guidance is 12.9, so we brought it down 100 units, just a point or so. The reality is it is a choppy environment that we're all operating in, and we're going to balance the way we push inventory. In some places, we're finding that pricing is pretty inelastic. So it's a modest revision. And as you, I'm sure, saw, we also...
Wow, I was muted the whole time. I apologize. So I'm going to say that again. Okay. So prior outlook versus what they're anticipating for home closings. It doesn't seem like much, but let me tell you, this difference right here is going to save home buyers thousands in negotiating costs in terms of instead of more competition raising the price, it's possible that prices are pretty flat, which again, for consumers are not so much trying to hit home.
inelastic. So it's a modest revision. And as you, I'm sure, saw, we also continued forward with our margin guidance with no change.
Right. More broadly, I mean, we did get mortgage apps down for a fourth consecutive week, even though we got the 30-year fix somewhere into the 6.3 range. Do you think it's a matter of time before the market responds to some of these easier conditions?
I do. I think that you've got, almost two camps here, Carl. I think from an affordability standpoint, we're all working very hard to deliver, homes to the marketplace at a price that first-time buyers can afford.
This is a great chart to look at. We've been talking about how mortgage rates, how mortgage rates have been moving down, and this is a really good, clear chart for you guys to look at to kind of see that visually, right? So, example, here it is. So, here's an intraday 30-year fix. Year to date, we're down 12, almost 13% from when we started. So if you notice, we were down here in the sevens, clearly in the sevens, by September, right? So September is when we really saw significant drops. Obviously, it started in July, but back down. This was the pullback. In October hit real high, which is normal pullback, and we went down. So again, this is very good signs for the real estate market. Down 12, almost 13% for the year. An intraday chart with minus 0.5 isn't great, but again, we're going to year lows, maybe 2-3 year lows pretty. Looking at today's chart, a pullback compared to yesterday. We went down yesterday, back a little. This is overall good news for real estate and consumers mainly who are looking to buy homes. Annie, how you doing? Welcome. Big Joe 217, welcome. So let's keep watching. Again, this is trying to bring you good, valid and information help inform.
And then when I think you look at certainly the bulk of our business, probably about 70%, there's just a lot going on in the macro. And confidence is, I would say not at a peak by any stretch. And so I think it's about time, some resolution on some of the issues we're seeing at a macro level, geopolitical level, certainly things like the hostages getting released, all of that, interest rates falling, all of that I think will continue to play well. And you'll see more of a reversal, especially since we have seen interest rates come down from what I would say was close to 7% just a couple months back to something just over 6% today.
Again, she's hitting the points I've hit on a lot. I'm gonna let her speak for myself.
A couple months back to since we have seen interest rates come down from what I would say was close to 7% just a couple months back to something just over 6% today.
Yeah, I mean, you would think that would help consumer confidence and also buying. Cheryl, what about what the president has been saying about you guys, the home builders? He put that post out where he compared you guys to OPEC for basically accusing you of hoarding land and restricting housing supply, similarly to how OPEC was doing.
Wow, this is interesting. Let's see how she comes back from this. This is pretty interesting to me.
Doing with oil. I mean, there was the post. How do you react to that? What does he want you to do?
So, Sarah, I think you know that nobody wants to build more houses than the builders in our country today, and we're walking a fine line.
Wiley girl,
sure
welcome
we
to
can
the stream.
deliver,
Thank you for joining.
Homes to the consumer and, balance that with pricing. As I think has been reported, there's been a number of meetings with the builders, and I believe it's honestly great for the industry that we're having productive conversations with the administration. The discussions are all about overcoming the housing shortages that we have in our country. And critically, how do we make housing more affordable? We have some excess inventory in the system today. I don't think that's a surprise. Builders are working through it. We need to be very thoughtful on how we do that.
There's a lot of excess inventory. I would say, to be honest with you, that's what kind of has me feeling pretty good about inventory going forward. Builders have built a lot of homes, but affordability has been down. So again, a lot of the people that have been buying homes are two household incomes, people with over six-figure incomes, investors, Wall Street, frankly, big businesses, but mostly investors, right? So knowing that all these homes have been built, refurbished, I think the inventory issue slowly away. Again, I'm not a pessimist, but again, just going off the data, they've been building a lot of homes, even in this environment. So I think over time, inventory issue.
But I think we can all agree that we have an affordability issue, and it didn't happen overnight. And it's going to require just tremendous collaboration by a number of stakeholders to solve this. It's bigger than just the builders. We actually represent a relatively small part of the entire ecosystem, but it's a complicated issue. The good news is there's a lot of good, smart people that are working on it. There's a lot that needs to be tackled, but I would tell you we're in early days on these conversations. More to come, rest assured. I think.
But
Taylor
can you
Morrison,
move that inventory? Sorry to cut you off, but can you move that inventory quicker? Is that what they're demanding to see?
I think some of the conversations, and I think there's been some mixed data messages that have come out on the number of lots we're sitting on. Honestly, that's the numbers that I think have been posted are both owned and controlled. Some of that land's not even entitled yet. We're all trying to move the inventory responsibly as quick as we can. I think Taylor Morrison and all the big builders want to be part of this solution. And there's not just one answer on how we make housing more affordable. But it's a priority. I'm glad to see it's a priority for the administration. We're excited to work with them. I'm confident we're going to see progress and new opportunities for the American people today.
All right. That was a really good video, short and sweet. We're going to be watching more, guys. So we're just catching up on a lot of news. Oh, this is a good one. I'm going to like this. Realtors, jump in.
Today we're launching a new look at the good, the bad, and the instructive in the housing market. Our senior real estate correspondent, Diana Olick, joins us with the results of CNBC's housing market survey.
Don't mind me. I'm going to make myself a tea. I'm having a late breakfast, guys.
Diana, good morning.
Good morning, Becky. Now, this is something of a sidewalk survey. Each quarter, we'll ask real estate agents from across the country and in a cross-section of neighborhoods just what they're seeing on the ground. Now, here are some of the highlights from Q3, when the average rate on the 30-year fixed mortgage was mostly on the decline, but moved up mid-September. Now, during that time, 49% of real estate agents we surveyed said it was a buyer's market, meaning that buyers had the advantage because homes weren't selling quickly and supply was sufficient. 30% saw it balanced, and just around 21% saw sellers with the advantage. As for prices, 44% said they saw them declining, 38% stable, and just 20% increasing. Now, again.
Hey, Apriya, how you doing? How's everything? Welcome to the chat. "1986, you're making me feel old here." Even though we graduated high school together, no? Thank you for joining the chat. I really appreciate it. Love. P. Sanchez, welcome to the chat, brother. Welcome to the chat. We're just watching some real estate news. Pretty cool stuff we're going to be looking into. If you have any questions, man. Same thing with you, Apriya.
All real estate is local, and market fundamentals are therefore different based on location, of course. Still, the trend is definitely for lower prices. And 89% of our agents reporting having at least one seller who decided to cut their price last quarter. That really shows how kind of over-optimistic sellers still seem to be, despite all the uncertainty in the economy and a slowing housing market. Now, even more drastic, 40% of agents represented sellers who delisted their homes due to those rough market conditions. So what will we see this quarter? Well, 48% of agents expect the market to improve and 35% think it'll stay the same. Just 17% expect sales to decline. Now, this is just a few.
This chart bugs me because this tells you the world's full of pessimists. Stay the same and decline. No, we believe that things will improve. We have to start behaving like that, with that posture of things will improve. You know what I mean?
Few pieces of this housing market survey. You can read all of the results, much more, many more insights on CNBC.com. It's posted right now. Back to you guys.
Hey, Diana, just in usually talking to real estate agents, it's generally pretty tough to get them to admit that it is a buyer's market, that it's a tough market out there. I think the statistics you just showed that 89% of them had cuts and 40% of them delisted. I mean, that speaks volumes about what's really happening there. It's probably an even worse picture than the 50% of them who say that the market's either for the sellers at this point or it's a fair and balanced market.
Yeah, I mean, it's interesting when you talk to real estate agents on the ground, and that's why we wanted to do this survey, because, you know, you look at the numbers from the realtors and there's a lot of indices and a lot of, you know, home price exactly, stuff like that. But it's really on the ground that you're going to hear from them, understand what's going on in their neighborhoods. If you put them on TV, sometimes they're not going to say it, just as you said, Becky. But in this survey, you know, we sent it out and they came back with real answers about what they're seeing. And as you said, a lot of them are very concerned about what's going on, state of the economy. They talked about how their sellers are feeling, how they're afraid to list some of them. So, you know, it's just a good way of knowing what's going on out there without the actual statistics.
Okay, so if anyone's still here and has any questions, feel free to ask. I'm going to go on to the next. Okay, so Q3 housing reports. We just looked at that. Mine's inflation lower than expected. All right, this is a good one.
Standing by Rick Santoni, that is, at the CME.
Very basic.
You're excited, Rick?
This is not emotional.
Yeah, excited isn't the word. The market should be excited, too. Here's our late but coming out September read on the Consumer Price Index. Headline number up 0.3, 1/10 cooler than both rearview mirror and what we were expecting. And if we look at the stripping out of food and energy known as core, it comes in also a bit less than expected, up 0.2. We were expecting up 0.3. Our last look was up 0.3. Here's the Moneyball numbers. Year over year, 3%. And even though it's less than the 3.1 we were expecting, it's hotter than 2.9. And after all, it's got a 3 handle. And if we look at CPI year over year ex food and energy, it also comes in at 3%. We were also expecting 3.1, but last look was 3.1, so it cooled a bit. So we're seeing interest rates move down and stocks move up. You may be asking why. An easy answer, because it's less than expectations. Is it less than the Fed's target of 2%? No. Which, in my opinion, that fact will rise above all the issues of the day at some point. But yes, we do see rates moving a bit lower. Ultimately, this is a very important number because the market, without any data points, has been pretty much viewed on the notion that the labor market is slowing, and that really is a good thing if you're looking for the Fed cycle to continue its rate cuts. Now, how does this figure in? I can't speak for Fed officials, but if you really have an agnostic view and you look at these numbers, the last thing you think about is we're closing in on the Fed's target. Joe and the gang, back to you.
In a nutshell, that's exactly what people said leading up to this, Rick. It's going to be higher inflation, but it's not going to be high enough to cause the Fed to change any of its plans. And that's what. And we saw something even better. Even if it was 3.1, I think that would have been the case. But even a 10th, I mean, these aren't huge moves, but definitely saw an uptick in the markets, in the equity markets, Rick.
Absolutely. And Joe, you know, when I look at stocks, don't you, most of the guests, don't they say, wow, it's getting a little frothy, it's getting a little frosty? My theory is, my epiphany is that the only honest metric we're getting about the U.S. economy now, in my opinion, is the stock market. Because I think all the professionals, I think they look at many things through the prism that's affected politically. And I think a lot of the weakness that we see showing up comes from surveys. And now I have a huge mistrust of surveys. You know what I trust? Credit card activity. And it's going pretty well. Wall Street Journal talks today about it's up over 7.5% year over year. It's outpacing inflation. And guess what? Joe, when you go to a restaurant, Becky, when you go to a restaurant, you get your bill. Doesn't it say you get a discount if you pay cash? My restaurant sources say that a lot of people are doing that. There's another group that's spending that doesn't even probably get counted.
Well, and the big issue, too, tips, whether they're in cash or electronic, because with the new tax legislation, if you get tipped electronically, it counts up differently than if you're tipped by cash.
Right.
That's
Exactly.
interesting.
Rick, the stock market has been telling us what to believe ever since Liberation Day. The stock market said this is not going to be the end of the world. Like so many, like almost unanimously, business reporters that tariffs were the end of the world, and here we are. You know, up. What are we up? 36% since then. Right. All right.
Yeah.
Treasury Secretary Scott Bessent has confirmed the names of 5 finalists to succeed Federal Reserve Chair Jerome Powell. President Trump has said he expects to make his decision by year end. Joining me to handicap the selection process and talk about the Fed's decision on interest rates this week is Stephen Junot, B of A Securities senior U.S. economist. Stephen, it's great to see you. So, I mean, these names have been floating around out there already. It seemed, how much attention is the market paying at this point? And at this point, would they be happy with sort of any of these selections?
Well, I don't think the market's too focused on it right now, just because we have a Fed meeting this week. We're still trying to decide, is this labor market slowing down significantly? Is it just gradually cooling? What's the Fed going to do after the next meeting? How is it going to deal with the shutdown? So I think right now the market's really focused on the near term for Fed policy. Chair Powell's still there. But of course, this will come up more and more, especially if we do get that announcement by year end.
It seems to be sort of looming over the process less than it was at a certain point, Stephen. Okay, so let's get to this week then. I assume you're in the camp of they're going to cut this week. What are you going to be paying most attention to at the press conference and in the sort of questions?
So I think we're just going to be looking for, you're right. It's absolutely basically a foregone conclusion the Fed's going to cut this week. But we're going to be looking to Powell to see, is he going to give any guidance for December? Because, for our current outlook, we're expecting the Fed to basically stop their cutting cycle this week, right? And just cut twice this year, take a risk management approach. We've seen some slowing in the labor market, but our consumer card data is holding up very well. The activity data seems strong still that we do have. But the issue that Powell's going to face and that the Fed's really grappling with right now is that absent last week's inflation report,
Angel
which
Eyes,
was
welcome
relatively
to the chat. If you have
benign,
any real estate questions,
they
feel
don't
free. JDE Beast, welcome to the chat, brother. Any real estate or mortgage questions, feel free to jump in and ask. Let's get back to this video. I'm going to be doing pull-ups in a little bit. That's with me setting up the pull-up cam. Every question is asked. I'll do 10 pull-ups.
Don't really have any data to go on. They don't have official data to rely on. So what will they do kind of heading into that December meeting? So we're all going to be looking to see, is he going to commit to December? It's really doubtful given that he doesn't have much data on hand. So I would expect we're really not going to get much out of this meeting in the end of the day.
So if that's the case, how and given that absence of data, how are you, Stephen, trying to figure out where the economy stands?
Well, fortunately, at B of A, we have a great set of internal data that we've done for some time. We publish on our consumer data. So we have a good read on that, a good pulse on the consumer. And that's been holding up well throughout this year, despite kind of that job market slowdown. There's also the private sector data on the labor market, ADP, Revelio, UKG, paychecks, the list kind of goes on and on there, where you can cobble together something about how the labor market's doing. But the real issue is that we don't really have great inflation data. And that's really something that we would expect to see a relative acceleration in the fourth quarter, not significant, but still firm inflation print. So we can get a picture of consumption and labor out of alternative data. It's no substitute for the official data, but we can at least have a picture there. But inflation is really that missing ingredient. So I think the Fed's going to be doing the same thing. And then, it becomes harder to kind of walk through that dark room or, continue to follow your path in the absence of data right now. So December will be an interesting meeting for sure, especially if they don't have data on hand.
Yeah. See, the other thing I want to ask you about when it comes to data is we have a lot of not macroeconomic, but more microeconomic data in the form of earnings, right? We're in earnings season. We're getting a lot of these companies that are commenting on things like price increases, things like the state of their workforce. We anecdotally have seen a number of layoffs recently from the likes of Target and other companies. Are you able to extrapolate something from those kinds of reports?
Definitely. And I think what's interesting is our equity strategists have been flagging that optimism's improving. And this is something that I think is critical to our own view that we're going to see this resiliency of the economy actually lead to a bit of a broadening out of job growth over the coming months, a bit of a broadening out of the CapEx outlook. Right now, the economy has been driven relatively narrowly. We're talking about jobs being created just in the healthcare sector, investment really just an AI story. But if we get that breadth starting to emerge, I think the Fed will feel a lot better about the economy then.
All right. This video is not bad, but let's review today's blog post from FundingUSA, my platform. You are on FundingUSA right now. Welcome. We're going to be reading this. The article today is called The Big Picture. Why now could be a smart time to move. Mortgage rates, home prices, and end of the year buying opportunity. Hey, Saul, 37, what's up, bro? Welcome to the chat. I'm sure you're going to ask, are rates lower? Which you usually ask every once a month. You're consistent, bro. I appreciate that. Shout out to the bros coming in the chat. Thank you, Lewis. All right, so we'll start with this. What's up, Lewis? How's the fam, man? Hope everyone's well. Sure you are, as always. And please feel free to chat and interrupt me. This is what it's about. This is a live experience. I appreciate you joining, bro. But I'm going to be reading this article I came up with. I'm going to lie with some AI help, but this is all my info. Okay, so according to the latest research from Fannie Mae, the outlook, hopefully not rates. Yeah, you're right. Well, look, I'll give you a little rundown for today. Let's look at the 5-day. So let me give you a quick while you're here if you want. All right, so this is the 3-month chart. You see, I kind of drew some lines there and kind of followed my path. So I drew that line and maybe look all the way back in May. And I figured that the interest rate market would slowly decrease. And as you can see, it has, right? So we had some pullbacks, some major downturns. So this is called the major downturn, pullback. Recently just had a pullback. That's like this December, beginning of October. If you look at the 5-day, up to me. So this is the 5-day. So in 5 days, well, not really, but like 2 weeks, we've gone from above 4.1 on the 10-year Treasury, all the way down to the lowest point where we had a 3.93. This was last week, I think, lowest rates probably 2 years, maybe. And then we have what we call a natural pullback. Right, we pulled back for about 2-3 days. So pull back, and then yesterday we got a nice downturn again. It was all green yesterday. crappy start. And then today, we're kind of balancing out right in the middle of all this range. This is called like a range. In this range, we're balanced out. Tomorrow is the Fed decision. But again, if you look at this overall trending chart, still a downward chart. So we follow the 10-year Treasury. If the Treasury is lower, mortgage rates are lower. Treasury rates go higher, the cost of the dollar goes higher, mortgage rates. So this is something, bro, you could put in your phone. Hey, 10-year Treasury. I think the code on this is NYR. So you put that like on stocks or Apple stocks or any account that you have, and you could kind of follow that to see that. So again, lower 10-year Treasury, lower mortgage rates, higher 10-year Treasury, higher mortgage rates, and that's how we have it. I'm going to continue reading this article though. According to the latest research, the outlook for mortgage rates and home prices have improved meaningfully. The recent forecast shows that mortgage rates are expected to at around 6.3 and by 2026 drop further to roughly 5.9. Well, the truth is we're at 6.3 now. If you have excellent credit with a conventional loan, 5 to 10% down, you most likely will get 6.3. Sometimes even as low as 5.9. I quoted somebody 5.9 with 1%. Another client of mine was quoted the same. So to be honest with you, we're already there. So they're predicting something that's true already. Likewise, home price growth is moderating, meaning buyers may face less steep upward pressure on purchase price. This is also something that's already kind of showing up. And essentially what they're saying is that these bidding wars that we see in the last 4 to 5 years where list price 500, you end up paying 540 is probably not going to be the case. Prices are still high, but prices for homes never really drop over time. It happened one time in the last 30 years, and that's in 2008. Other than that, it's steady rising. But moderating means that it's not moving so much. There's fewer people out in the market because it really does take 2 incomes to buy a home nowadays, unless you got it like that. But the point I'm making is fewer buyers out there. So there's less competition. Prices tend to stay flat. I had 2 clients that got offers at list price recently. That should tell you something. For mortgage professionals, this created a narrative of improved affordability and window opportunity. You can. Why does this matter? For agents, with rates expected to gradually ease, buyers might be able to lock in a more favorable payment now or in the future. Clearly, that makes sense. Lower rates give you better payment. Moderating price growth can help with affordability, even if rates remain above historic lows. The combination can improve buying power. We kind of went over that. If you act now, you can position clients to benefit from the tail end of tax advantages. Yeah, so we'll talk about that in section 4. But for real estate agents or people who are out there really shopping, rates in flux, buyer window opening. Use this to re-energize clients to search because of higher rates. So a lot of people, including you, Lewis, you take breaks because mortgage rates are high. Fine, you have a family. I'm not going to judge your decisions financially, but this is a good time for you to come back in the market, right? Because rates are slowing down. Let me see if I can. Jersey. So here's the New Jersey rate program. So the first-time home buyer with down payment assistance, which is an FHA loan, it's at 5.5. I mean, you're not going to get that anywhere in the market. But with this program here, you will get this. And it comes with a $15,000 grant with as a first-time home buyer, or $22,000 as a first-generation home buyer in certain places in New Jersey. So 5.5. This is another FHA product, but the income limits are a lot higher. So a couple with good income can probably qualify for this, and 0.75. Now again, I must add that none of these programs have points. This is straight up. And then the HFA Advantage is 6.375, which is a conventional product, really in line with conventional rates right now in the market. So if you look here, 30-year fixed mortgage, 6.19 estimate. I'm gonna mute myself. I'm getting a sales call.
And it won't feel as fragile, and they won't have to cut all the way to say neutral. They can kind of just take this risk management approach and then go on hold again for a while and see how things play out. So that's what we're taking from the earnings report. Obviously, there's been a lot of beats, so that's positive too. We've seen a positive wealth effect probably contribute to a strong consumer. And obviously markets continue to rally, so that's a positive for the consumption outlook too.
Yeah, and for that wealth effect. Stephen, finally, I want to ask you a question about U.S. and China, because we got those headlines that it looks like the U.S. and China are moving towards at least a détente, maybe some sort of framework for an agreement. We haven't talked about it as much lately from an economic perspective because it's been this sort of back and forth. But I am curious in terms of U.S.-China trade and its contribution to U.S. economic growth, kind of where we are now versus where we were on the last day of 2024. You know, like how do you even sort of compare that, and what does that look like?
So, I mean, both countries, I think, have done a decent job of decoupling from one another in terms of economic impacts. The U.S. is a large closed economy, so depending on, say, exports to China, soybeans, airplanes, that's so not really going to make or break the U.S. economic outlook.
Okay, so we're seeing nice drop off. Let's go to a one-day. Started. All right, so this. Okay, so this is today. Started off here, went down. I was watching this earlier. Went all the way up to recent highs. Again, recent highs, not in crazy. And now we are slowly getting back to yesterday's close. So we're 9.09 basis points close to yesterday's close with a nice little comeback coming for the day. Good. We'll get back to my article now. All right, so what's going on at the Fed and in the economy? This is something that I really want to kind of review. While the Fed is not a direct mortgage rate setter, its policy actions and economic data influence market rates. According to Mortgage Professional America, despite a data blackout caused by the government shutdown, the consensus is that more rate cuts by Federal Reserve are likely. Primo, ¿qué es lo que? Me dicen que ya tú vienes por ahí. The data blackout means less clarity on economic metrics like employment, inflation. That uncertainty can make markets cautious, but it also boosts hope for future easing. The expectation of more Fed cuts tends to generate downward pressure on long-term yields, which indirectly helps mortgage rates. Correct. This is another truth. Market watchers are looking at the psychological thresholds of mortgage rates. Even a small permitted drop, say from 6.5 to 6.3, could spark greater demand. We've seen that. There's been a slight refi boom in the last month, and that's because the media is helping and they're pushing positive mortgage. All right, so this one is key. We were talking about Section 4, the end of year home buying advantage. One of the most compelling pieces for your blog is the advantage of buying a home before the calendar year closes. According to Realtor.com, buyers who close by December 31 can access tax deductions, mortgage interest, property tax points for the year. So this is crazy. If you close before this end of the year, you can use all these deductions and tax advantages to you when you file. So again, you can save some money for your family. Fall and early winter often bring lower competition and more motivated sellers because they want to close before year end and translate into better deal terms. For agents, this creates a sense of urgency. Let's prep now so we're closing in Q4 and capturing those benefits. So let's really hit the phone, see if we can get more clients out there to take advantage of these benefits. And here's my closing thoughts. In summary, the conditions are aligning for a potential window of opportunity for home buyers. Mortgage rate outlooks, moderating home price growth, and strong fiscal tax advantages for year-end closings. For borrower clients and a real estate partners, this is the time to act, not just wait. If you're a real estate agent partner, Lovins, what's good, my brother? Happy birthday, my guy. Happy fucking birthday, bro. Salute, bro. I didn't get to text you. I've been having a busy morning, but happy birthday, my guy. If you're a real estate agent partner, let's talk this week about how we can collaborate to tap into this momentum. I have 3 realtor meetings this week, trying to just create this energy going into, which is Q1 of 2026. So, realtors, hit me up. We can do live streams, we can do videos, we can do a lot of stuff here. All right, so that's that article right there. Again, we're up to 8, down 0.08 point. JJ Assurance Group, welcome to the stream. We're just kind of monitoring 10-year treasury right now. We'll come back for the morning, thinking we'll be at break even for the day by noon. Again, I'm not a pessimist, I'm an optimist. I like thinking positively about the market. Let's keep going. We have some more stuff to listen to. Getting work emails, my people. This is a mortgage lender's lifestyle. All kinds of emails coming in. Stop some document. Now, I got in trouble last time I was watching this baseball or football highlights, and brother, it was so tough because basically I got banned from every platform I was on. That's why I haven't streamed in 2 weeks. So I gotta learn more about this live streaming thing, especially when it comes to streaming sports and legal compliance, copyright. This is just stuff I gotta really understand and learn more about. But you know what? Doesn't matter. We're learning. We're picking this up. I'm not even gonna look. Let's not go politics. Let's look at the Schwab network and see what we have going.
Need to do this year. I think the debate is good. It's just how much they present it in dissents or in the meeting where there's division and they can't come to a consensus. And I think Chair Powell's done a good job. Obviously, we've had dissents across the last 2 meetings, but he's kept a pretty good consensus over his term through a lot of rocky times with these, when they were hiking and now in the easing phase. So I think keeping that consensus is up to Chair Powell and how we go from there. And then the market reaction to that will be whether or not we have too much division and dissents.
So, guys,
and
this
as
is the
you
top
mentioned, we've
of
been
all
listening
the
to these
news
Fed
right
speakers
now.
like reading tea
Is the
leaves,
Fed
trying to
gonna
read
cut
into
tomorrow?
every single word of
That
everything
is
everyone's
the biggest
saying.
news
And Jerome
in
Powell's been
real
driving this
estate,
narrative
in
that the labor
mortgages,
market is
in
the
the
focus. But
economy
inflation is also sticky.
until
You
tomorrow
mentioned that, and the
afternoon.
data supports
It's
it.
not even
What do
close.
you think that
Again,
the
let's look
more
at-
important part of the dual mandate is right
let's
now?
look at
Is it the
tomorrow.
labor market
Tomorrow
or
we
is it addressing inflation?
Fed interest rate decision.
I think
press
they've
conference,
definitely
2 and
shifted
2:30.
it to the labor
I
market.
will be
We
streaming
were
tomorrow
saying
live,
inflation,
watching that. I'm
inflation,
also streaming
inflation
tomorrow
for
at 5
so
to
long
7.
that they finally, they
again,
pivoted, kind of late.
I'm trying to stream
or
every
middle
Wednesday, 5 to 7,
last
just
year
to
when they
get
got some
some
bad job reports, and then they did the
activity going,
the
build out these channels. So
50
thank you.
basis point cut last September. Now, the labor market kind of soothed out, but then we got a little weaker numbers this summer again, and that's what started this easing again. So if they deliver the 25 tomorrow, which we expect, that'll be 150 basis points cut off their peak, 550 on the upper band. So it will get them down to a less restrictive level. So I think that's the key here with the labor market is they want to prevent any further weakening. So even though the inflation is running a little higher than their target and it's trading sideways here, even though, like I said, we got a little weaker than expected in the September CPI print, I think the hawks are going to be a little worried, and that's why they don't want to do a lot more. So that's why I think maybe you get the one more in December, maybe one more early part of next year, maybe at the March meeting. And then they're kind of in this wait and see again to see, maybe they've done enough to stop further weakness
that wasn't
in the
too
labor
bad.
market, but
I got
they're still
2
worried
solid
and concerned that
pull-ups.
their inflation is running much higher than the 2% target.
Well, Jason, we appreciate you taking the time to join us this morning to preview ahead of their policy decision tomorrow afternoon from the Fed. That's Jason England, the Managing Director and Portfolio Manager at Simplify. And we've got plenty more to come for you on Trading 360 today. Next, we've got the big 3 stocks, 3 charts, and 3 trades. Kevin Green will be here to take us through the technicals, and Mike Shore will take us through the trades for Supermicro, Astera Labs, and Reddit. That's next on Trading 360 on Schwab Network.
All right, so we're going to be reading today. We're going to be learning, man. Pause this. All right, hopefully there's no... Nope. Well, Fed rate cut decision looms as ADP data shows slow job growth. All right, so pretty straightforward. Weekly jobs gains may influence the Fed's next move on rates by Hazel. The United States labor market showed tentative signs of recovery in October, according to new data. Weekly estimates of private sector job growth are filling a gap left by the delayed government. ADP's preliminary figures indicated that private employers had an average of 14,250 jobs per week over the 4 weeks ending October 11th. This growth in employment suggests that the U.S. economy is emerging from a recent brew of job losses. Hiring has begun to increase from September levels, albeit slowly, and without the positive momentum we saw earlier this year. I can see you guys. Sorry, guys. Okay. This tepid recovery could support economic growth. However, because our run of week over job losses seems to have been relatively short-lived, new weekly release ADP said will be published every Tuesday comes as the U.S. government shutdown continues to disrupt the release of official labor. With the Bureau of Labor Statistics sideline, ADP data has become a critical resource for market watchers and policymakers seeking real-time insight into employment trends. The shift to weekly reporting marks a significant change for ADP, which has published monthly payroll data since 2010. The company's new cadence is designed to provide a dynamic view of job creation and loss at an unprecedented level of weekly. The preliminary numbers, which will be revised within the monthly National Employment Report, suggest a modest rebound from the 32,000 private sector job loss in September. So we already talked about the Fed's rate cuts and all that. That's fine and dandy. Let's do that. Yesterday, this is very technical. I don't want to show you guys that kind of stuff.
The answer is yes to your long-winded answer to your question, but yes.
But a good one. Dan, it's great to see you. Thank you so much.
And this abundance that he's going after. So why didn't you include energy products as a stated goal?
Yeah, so there are many different goals that we looked at. Energy is an important part of the Tesla product lineup today and in the future. And you can see the impact that energy is having not only on the results, but also on the transition to sustainable energy longer term. So it is embedded in the plan. The EBITDA goals that we have as a company, you can't get there without a robust energy outcome. And so, again, if you look at the results of last week, energy contributed very significantly. And to get to $400 billion of adjusted EBITDA is a monumental task for anybody. No one out there, at least to my knowledge, is at that sort of level. And so even the first EBITDA goals at $50 billion is nearly 3 times our highest EBITDA goals that we've had. So from our perspective, it is absolutely embedded in the goals. To your point, it's not a specific line item in terms of the revenue or the units or the kilowatts of energy or megawatts of energy that are out there, but it is implicit in the plans. And the master plan for, talks about that as well in terms of getting to sustainable abundance.
Robin, has the special committee and the advisors that you took on discussed the use of interim awards in the event of a no vote and how you might replicate what you did already?
Well, there's an important other measure on the board as well, proposal in terms of increasing the share pool that we have, firstly for our employees. As you know, we're in a talent war at the moment, particularly around AI talent, and adding to the employee reserve as part A of that to actually increase the amount of equity that we have for our employee program. But secondarily, we've also asked shareholders to add to the pool in the event that we need to award an amount to Elon to compensate for the 2018 plan, because as you know, we put an interim award for roughly 1/3 of what he earned under the 2018 plan, given the appeal that is ongoing in Delaware at the moment. So we have not ruled that out. The special committee was charged with looking at all matters compensation-wise. As you're aware, in August we did actually award an interim award, which does have a 2-year vesting period and is forfeited if we win the appeal in Delaware for the 2018 compensation program.
It does seem then to be about money. And I'm interested as to how you continue to, you've made very clear it's about influence as well. Some of the feedback has been just the gargantuan amount that could go to Elon in terms of monetary value. But then others are worried about the dilution to other shareholders. How was it in just no way possible to give him more voting rights without the $1 trillion mega money bonus, it feels like?
Yeah, I mean, we looked at many different instruments to be able to